Welcome to the final episode of our Valuation series. I'm Hindol. Over the past 7 episodes, we have built a comprehensive understanding of valuation methods, adjustments, special situations. Today, we'll put it all together. How do you use valuation strategically? How does it inform capital allocation? How does it inform M&A and value creation? This is where theory meets executive decision making. Valuation as a strategic tool. For CFOs, valuation is not an academic exercise. It's a foundation of capital allocation, the most important job of any executive team. Every capital allocation decision is implicitly a valuation decision. When you invest in a new product line, you are betting that the NPV is positive, that the present value of cash flows exceeds investment. When you buy back stock, you are signaling that shares are undervalued relative to alternative uses of capital. When you acquire a company, you are stating that your valuation exceeds sellers. The discipline of valuation forces you to be explicit about assumptions. I've sat in strategy meetings where people advocate for investments based on intuition. And that's fine. That's fine as a starting point, but I need to see the unit economics. I need to see the cash flow projections, the risk-adjusted returns. Valuation also creates accountability. When you make an acquisition at $100 million, you have made implicit projections about synergies, about revenue retention, about the cost takeout. And 3 years later, we can actually measure the performance against the model. Did we create the value or did we destroy it? So here's a framework I use. Every single capital allocation should have a pre-mortem. Assume that the investment failed. What went wrong? This forces you to identify the key risks embedded in your valuation. Let's talk about the art of M&A valuation though. M&A is where valuation becomes intensely practical and political. So you have a buyer's valuation and then you have a seller's valuation, and usually there's a significant gap. As a CFO who has had acquisitions from both sides, you've done acquisitions on both sides, here's my approach. Start with standalone value. What is the company worth independent of who buys it? This is your DCF of current operations with modest improvements. Once you do that, then you add the synergies. Revenue synergies are hardest to realize: cross-selling, market expansion, bundled offerings. So I discount those a little bit heavy, maybe about 20 to 25%. I look at the probability of realization. Cost synergies are a little bit more reliable because you're eliminating redundant functions, consolidating facilities. I might assume 70% realization. And be very specific about synergies. Overhead reduction is too vague. I want to see which positions are eliminated, which facilities are closed, what is the timing, what are the one-time costs to realize those savings. This synergy value is the present value of these incremental cash flows. But here's a critical strategic question. How much of the synergy value goes to the seller versus how much of it goes to the buyer? If you're the only bidder and the synergies are generic, available to any acquirer, you can capture most of the value. If there are multiple bidders and synergies are unique to you, you might have to pay most of it to the seller to win. So I use a rule. Never pay more than standalone value plus 50% of synergies. Leave some value for your shareholders. I've walked away from 2 deals where we had to pay 100% of synergies just to win. That's not value creation. Due diligence is where valuation meets reality. Your model assumes 85% customer retention. Well, does the data support it? You assume 20% cost reduction. Are those costs actually variable, or are they embedded in long-term contracts? You have to create a valuation culture mindset, right? The best organizations, they embed valuation thinking throughout the culture. It's not just a CFO function, it's just how everyone thinks about investment decisions. Product managers should understand that the customer lifetime value that they are targeting, what is the customer lifetime value that they are targeting rather? If the acquisition cost is $500 and LTV is $400, you are destroying value. They should kill the initiative before it even scales. Sales team should understand not all revenue is equal. A 5-year contract with a Fortune 500 company has a different value than a 1-year contract with a startup. Price appropriately and value appropriately. Operations team should understand that efficiency improvements that free up cash have NPV. Reducing days sales outstanding from 60 to 45 days is worth real money. I've implemented quarterly value creation reviews where each function presents what initiatives created value this quarter and what is the measured impact. What is the projected impact of current investments? And this shifts the conversation from activities to outcomes. And here's a framework I call the value bridge. Start with the current enterprise value, break down the drivers, revenue growth, margin expansion, capital efficiency, and multiple expansion opportunities. And for each strategic initiative, show which driver it impacts and by how much. This connects strategy to value creation. The other is to create a cultural element, intellectual honesty about sunk cost. I've seen execs defend failing investments because we have already spent $50 million. There's $50 million that is gone. And the only question is, what is the NPV of the additional investment? Because everything else is sunk cost. Be willing to shut down value destructive initiatives regardless of how much you have poured into it. And finally, teach probabilistic thinking. A single valuation number is usually wrong. Think in ranges and probabilities. This acquisition has a 40% chance of creating $50 million value. 40% chance of creating 20 million, 20% chance of destroying $10 million. Then do that expected value calculation, maybe $30 million. Is that enough buffer over the $25 million purchase price? So we have covered a lot in this series. We talked about DCF, we talked about fundamentals to market multiples, from premiums and discounts to intangible assets, from special situations to all these strategic frameworks. So it's a lot to take in. Here's what I want you to take away though. Valuation is not about finding the right number. It's a discipline for thinking clearly about value creation, understanding risk, and making better decisions under uncertainty. The best CFOs are not the ones with the most sophisticated models. They really are not. They're the ones who understand which assumptions matter, who can explain valuation to non-finance execs in terms of business drivers, and who can create the cultures where value creation is everyone's job. As we face increasing complexity, technological disruption, and market volatility, and stakeholder activism rather, the fundamentals remain. The value is created by generating cash flows in excess of capital costs over a sustained period of time while managing the risks. So thank you for joining me on this journey. I'm Hindol, and if you found this valuable, I invite you to explore more content at efuturecfo.com and this channel.